Welcome. I'm here with Mike Loukas, the CEO of TrueMark Investments. We're talking thematic investing, new economy asset classes, and what TrueMark is all about. Mike, thanks for joining us. How are you?
I'm well, thank you. Thanks for having me.
Awesome. Great to have you here. It's the first time we've had the chance to chat with you, so really excited to learn more about TrueMark. The TrueShares Technology AI and Deep Learning Fund, LRNZ, invests in hyper-growth companies with accelerating fundamentals that utilize AI and deep learning as a competitive advantage. What separates them from more speculative story stocks in similar categories?
It's a really, really good question and a timely question, considering what's happened in the tech space in the last, we'll call it 6 weeks, 8 weeks. We've seen some significant seismic shifts in valuations. But the reality is we're thematic in the sense that we will pursue a technology, we will look at a competitive advantage, but we'll invest across asset classes. So when you look at the AI and deep learning fund, which is LRNZ, you see that LRNZ will focus on companies that utilize AI and deep learning as a competitive advantage. Now, what does that mean? Where do we get those ideas? How do we isolate and analyze companies that do that? The reality is we look to pre-IPO qualitative analysis. We call it the controlled chaos stage. So we'll start following our companies in their sort of the B and C round of venture capital and or private equity, and we will follow qualitative analysis all the way up to their pre-IPO stages where we start to see the quantitative evidence of those trends early on. And then the IPO stage and the quarterly reporting following that, we call the confirmation stage, where the hyper growth trajectory of those companies can be verified quantitatively. And so, what does it mean to pursue and invest in a company that has a competitive advantage versus a story stock that might be a little bit sexier in the news or sort of in the chat rooms? The reality is one of the first things that you need to look at are not only high revenue growth but high gross margins. Okay, you want to see fundamental acceleration. You need to see earnings. Oftentimes, we look at stocks and we say, well, none of them are earning a profit right now. Yes, but that doesn't make them all the same. Companies that are generating high revenue, high sales growth, and high free cash flow, the earnings will follow. It's a great testament to the fact that they're on the right track and they're in a space where competition is limited because it's a new segment, it's a new tech segment, and their competitive advantage is for real. And so we've tracked that from 18 or 24 months before they go public. We continue to confirm that and verify that as they go IPO and then trade in the public markets. And that's a very different concept than a story stock that seems to have a buzzword attached to it. And that's the funny part about tech, right? Is that new segments can be created out of the blue. And so you're on your toes for that sort of thing. And a lot of investors will react to a buzzword or a space, and they'll try and grab anything that's connected to that space. Our job is to really sift through that noise. That's a controlled chaos stage for us. We sift through that. We identify companies that have accelerating fundamentals that show extreme growth in customer base, customer satisfaction, and then certainly that follows with increase in revenues, increase in free cash flow, and the rest falls into place following that.
Perfect. Okay, a little bit of a deeper question on that drilling in. Learns pursues a concentrated portfolio, unlike most other AI tech-related funds. Why is this unique? But what are the benefits to that more specifically?
Well, concentrated portfolios are, um, in the business as investors, we've almost been trained to think that's a bad thing, right? We've been trained to believe that diversification is your friend. In some instances, it may be. In some instances, it certainly is. But in tech investing, where the winner take all theory tends to be more prevalent than other segments, the idea of concentrated investing makes a heck of a lot more sense. And in fact, it can likely reduce your overall risk because when you have a diversified investment, you're actually owning losers alongside your winners because you're spreading your bets, so to speak. A great example of that is, if we look at the performance of the stock market in the last 10 years, it's done quite well from an overall standpoint. But if we drill down into what we call attribution and we look at what companies and what stocks have contributed the most to that overall performance, you see that most of it came from FANG, right? Facebook, Apple, Amazon, Netflix, Google. So when you talk about concentration, you look back on it and say, well, what if I just owned those companies and I didn't own, 100 other, 200 other companies that may not have performed as well? Then I would have had, logically speaking, a much higher return. So the same is true in tech investing. When you look at a new tech segment, such as the ones that Learns focuses on, the idea is that there are going to be one, two, maybe three names in that segment that are the likely category killers. They're the likely name that's going to win that category long term, going to become that household name that 10 or 15 years from now we'll all wish we had invested in when it first went public. So it's a bit counterintuitive to the way that a lot of investors have been conditioned to think. But a concentrated portfolio, particularly when you're an active investor, is, in our opinion, the better way to go about building a tech portfolio.
Okay, interesting. So the last question for you is more of a technical question, but why would the secular growth stocks in Learns in the ETF be viewed as untrendy relative to similar funds? Is there a reason that that perception might be held by the average investor?
Well, I think the average investor uh, tends to be blind to secular growth, right? I mean, again, it's the idea of the trend following investment, the buzzwords, if you will, the idea that you know, Facebook changes its name to Meta and everyone runs out there and buys anything with Meta in the name or that they think is connected to Meta. And so it's the idea of understanding who really has the competitive advantage in a segment and identifying those accelerating fundamentals. One of the phenomenons that we witnessed, during the lockdown of the pandemic was the onset of the work from home trade, quote unquote, or some trend following trades where all of a sudden the general public and the general investing public awakened to the idea that we're in a digital world now, and that global digitalization is not going to reverse itself. And when you talk about cloud migration, we're maybe 10%, 15% into cloud migration, and the first inning of a 9-inning game. And so, the general investing public became aware of all this because all of a sudden people had to work from home. And they thought, okay, well, communication protocols like Twilio, or cybersecurity is going to become more important. I mean, but the reality is these secular growth companies, they were accelerating pre-pandemic. They accelerated through the pandemic. They're accelerating after the pandemic. So when you have, somebody like Jim Cramer jumping on CNBC saying, "Sell anything that's not, making money, and sell anybody that's negative earnings." Well, it's not that simple, right? I think the reality is when you see macro events like rising rates and sort of a flight away from growth, that's when you see these story stocks, these trendy stocks get buried because they don't have the fundamentals to back up the fact that they're taking advantage of that trend or that they're going to be a potential category killer with that trend. The secular growth companies, they're the ones that have been showing that acceleration, as we just mentioned, pre-IPO, through the IPO, following the IPO, and the confirmation process. And that happened pre-pandemic, through the pandemic, and it's still continuing after the pandemic. So when you look for those metrics and you realize that there are companies that have a very distinct competitive advantage, they're still leading the pack and showing every sign of uh, possessing that growth trajectory, regardless of macro events, then you've got secular growth. And there's a very different feel to secular growth investing versus investing in those story stocks, as you mentioned.
Okay, really interesting perspective. Mike Loukas, the CEO of TrueMark Investments, is the first time we've had the chance to chat with you, but we're going to be back again very, very soon discussing the market. Thank you again for being here.
Thank you very much.